I'm Ben Summers, and welcome to the Shadow Banker's Secrets podcast, based on the book I wrote by the same name. To help guide today's discussion, I've got my good friend and colleague, Stephan Piscano.
Awesome. So, Ben, we talked about a lot of the success that you've had in the financial sector. And I think for me, and, obviously I'm a real estate investor, and that's how we initially met, was in that sector. And I think you get painted a lot with that brush like you're a real estate guy. And it's funny for us because we joke about it. In fact, we just were off camera. That people think that's what you do. And in reality, it's a tiny fraction, if that, of what you do. So can you talk to me about your evolution that you had of what took you out of some of the investment strategies that you were doing in the real estate sector into the kind of mainstream finance sector, and really what different asset classes are you focused on and strategies at this point in time in 2022?
Yeah, and people, and in fairness to people who do paint me with the real estate brush, what we do is objectively complex, right? And so when you are telling a complicated story, people tend to gravitate to the piece that's familiar to them. And so a lot of people, I think, see a lot of like gibberish, and all of a sudden the word real estate pops up somewhere midstream, like, that's it, right? That's what I gravitate to. So, I started out in real estate as an asset class, and then in the effort of raising money, or attempting to raise money early on, I understood that I had to learn the business of finance to be successful in doing that. I mean, that's what finance is. Finance is capitalization, raising money. And so eventually, that path took me into managing a real estate fund, which then evolved into creating structured products, and ultimately investment banking, where now I don't trade strategies directly at all anymore. We capitalize other asset managers who trade with better risk-adjusted performance than what's otherwise available through traditional markets. And that is the only thing that matters. So we are truly asset class agnostic. Whether you're trading equities to bottles of wine, we don't care, as long as your accurately measured risk-adjusted performance is better than what's otherwise available. So now, to be fair, it is very, very difficult, nigh impossible, for any equity strategy, regardless of the algorithm, the sophistication of the trader, and I do not mean to impugn the sophistication of equities traders. They're the smartest people going. But they're constrained by the efficiency of the equities markets. So it's just impossible, no matter who they are, what they do, to generate better performance than what you can achieve within a private market that's just got a plethora of arbitrage opportunities to pursue. So in terms of asset managers, we do look at some equity strategies, but real estate, energy, you name it.
Ben, I don't know the answer to this, honestly, but are there regulatory, because I know just on the real estate side myself, like if I do a, Reg D fund or whatever for a real estate project, there's certain guidelines I have to follow on the raise for the capital that actually, and sometimes can prohibit me from making a higher return than I could if I just had all the cash myself, so to speak. Is that in any way true? And I don't know the answer. Is that in any way true with the big boys on Wall Street, to where are they limited in any way by regulations to where there's things they could take advantage of, but they just simply can't because of the structure that their product is?
My gut reaction is to say the opposite is probably true. And what I mean by that, the regulatory agencies are owned and run by the industry. So FINRA is a self-regulating organization, which means that it is ostensibly run by the companies or the firms that constitute the industry. Even when you look at the pure governmental side, the lobbyists write the laws and then bribe the politicians to put them in place. And the regulation around securities is unbelievably expansive, and even worse, it's deliberately and unbelievably vague. Like many terms just simply aren't even defined. And that's not by accident. So these regulations are put in place by the firms that dominate the industry to stifle competition, not to stifle themselves, right? So what they've done is basically left very expensive loopholes that only they either know how to or can afford to navigate. And then they tell everybody it's for the good of the public, which is just right. But that's where we've lived. And what I mean by there is the loopholes in the regulation that have been kind of designed as a back door by the writers, the authors of the regulation, are the same loopholes, regulatory exemptions that we compliantly operate within. And a big part of what we do is utilizing those exemptions in a way that allows non-institutional asset managers, or at least people starting out as non-institutional asset managers, providing them access to capital markets with minimal impact from regulatory constraint.
That's great. Well, and I don't want to jump ahead here, but I mean, that's what's so interesting for me, Ben, is because like I said, I mean, I've done a lot of deals. A lot of people have done a lot of deals. That's the funny thing is like there's so many levels to this to where there's people that are totally passive investors, really smart individuals. They've been successful in their chosen field, but they know nothing about investing in any sector. But they have capital they want to maximize. That's great. That's an obvious fit. Then there's people, you know, maybe I'm in this category, maybe I'm in the next one. They've had some success as an investor, whether in real estate, stock market, whatever it may be, but they don't know the regulations. Then there's kind of that next tier that are savvy professionals. Maybe they even manage a fund, but they don't know that upper tier echelon of how to protect themselves, their investors, and their strategy within the framework of what's available today. And that's so key because like, you know, and I don't know if it was Buffett or somebody said it's not how much money you make, it's how much money you keep. That's so key to know the ins and outs in that upper echelon. And that's what you do. And I mean, that's how we met, right? I mean, you know, like I said, you know, one of our other discussions, I've known him for going on 8 years now. And we originally met, I was doing kind of marketing consulting for a pretty large investment fund out of Chicago. And they brought you in as, to my knowledge anyway, correct me if I'm wrong on the terminology here, but an SEC compliance expert consultant. And I was initially just blown away by your knowledge base. And once I learned that you had the investment bank infrastructure in place, that's what gave me extra, confidence in what you do. Is that's how I met you, was as the compliance guy. So it just gives a little extra credibility to everything we're talking about here, that's the framework that you present it from. So can you talk to me a little bit about how that transpired and if I'm saying anything inaccurately there with our backstory?
Yeah, you paint me with the compliance brush when everybody else paints me with the real estate brush. And yes, compliance is a thing that we do, and it's a very important thing, but it's only one thing. Now, it just so happens that most emerging asset managers, especially those in real estate, are in desperate need of compliance guidance. But that's not the moneymaker per se, right? That's just the keep the money that you make piece, right?
No, well, see, that's the thing, Ben. You know, it's great to have a great strategy. Honestly, it's hard enough to come up with an effective, profitable strategy in any sector, whether it's real estate, stock, crypto, gold, whatever it is. But once you do that, you've really only started the process, right? Because then you have to be able to get enough funds to properly execute your strategy, which there's a whole level of compliance infrastructure required to do that. Then if you are lucky enough, smart enough, connected enough to get access to be able to do that, you get the funds to execute your strategy, then you have to know how to protect yourself enough to be able to scale it up and actually keep your funds. So how much, I guess I'll just ask you layman's terms, how much of what you build, how much of what you do, you teach in the book and one-on-one helps people kind of take it from, okay, I've got a great idea, I've got a profitable idea, I want to scale it.
So that is the crux of the entire book, and it's broken down into three components, right? The first major component talks about risk analytics, how to measure and design a strategy that's going to perform well within markets, right? The second one is fund structures, how to build an investment vehicle that compliantly allows other people to participate. And then the third section is on marketing, distribution, and compliant execution thereof. So it really is a holistic approach. You can't take one without the other. And kind of speaking to the marketing point, the reason with respect to PMV that I was kind of given the compliance hat is because that was their biggest need, right? I had produced a course on real estate investing and investment banking, and they recognized that I probably had the insight they need to rescue them from their compliance troubles. So for them, compliance issues were at the forefront of their mind, and that was their hook, or inadvertently, that was my hook into them, right? So that became the theme. Yep.
Yeah, I mean, and that's what's neat about, neat's not the word because it's pretty profound, really, but I mean, that's what's exciting about what you do is you kind of can fit into anywhere that the need is. And anyone that's looking to scale up an investment opportunity, I guess is the way I would say it, Liam. I'm sure there's a smarter way to say that. Whether it's somebody like me that's raising, millions of dollars potentially, or it's somebody like, I know you've got clients within the investment bank structure that have billions with a B under management and everything in between. Am I correct in saying you kind of have a little bit of something for everybody, for lack of a better way of putting it?
That's why I call us an investment bank, because operationally we are. Even though from a regulatory perspective, an investment bank is a licensed broker dealer, meaning that they broker and deal in securities. We don't broker securities. We are the principal, and the closest parallel, the analog, might be a fund of funds, although not the same. There's some stark differences. But that being said, all of the expertise and general services that an investment bank can provide, we can either provide ourselves directly or through Morgan Stanley, who covers us on the back end. So in other words, we don't come to the market with a cookie cutter saying, hey, fit into this shape. We've got a very deep bag of a great number of very sophisticated solutions and skills and resources. And it's our job to apply those however is needed to solve whatever problems a potential client may face. So in the case of PMV, the first problem that they recognized was compliance, right? There are a lot more problems that we wound up uncovering and dealing with, right? But again, you can't convince people to do things that they aren't predisposed to do. So you got to meet people where they are. And thank God, I mean, they were at least cognizant of the need for an improvement on the compliance front.
They tried, yeah. Well, but I mean, I think, and that's a sad story, but I mean, I think on a positive note, that's what, for me personally, really gave me an extra level of kind of confidence, I guess, faith in you and what you've built there, to where I saw it. And that's what I wanted to, with whatever my involvement in your podcast is and these discussions is to try to give people a glimpse of that, Ben, because it's powerful. I mean, in reality, and I know we've talked about it to where I know to some extent you feel like the track record should speak for itself. The numbers should speak for itself, and they should. But it's powerful. Somebody like me who's known you and gotten to see you warning people, like with, PMV, the funds where we met. Like, hey, guys, you're doing it a wrong way. You could do it a different way, and everything would be okay. They didn't listen. They had issues as a result, and a lot of people were damaged by that. And you warned them. So that's why now, for me, that was powerful in a really unfortunate way. But it was powerful for me to see, again, in the moment, you shouting from the rooftops, hey, guys, there's a better way to do this. So
a necessary way to do this, or you're going to go to fucking jail.
That too. That's a big thing too. But I mean, but it's serious. I mean, that's why it's imperative for me. It's like, guys, like, we're not even selling anything here or anything like that. It's just like, this information's important. I get it. We shouldn't have to add the credibility piece, so to speak, for people to listen to it, but everybody wants to hear that, including me. I got to see it up close. I want everybody else to get a glimpse of that. The only reason I want that is so that they listen to what you're saying. So on big scales like PMV and small scales like all of us as individual investors, we can learn from mistakes of others, learn from mistakes of the past, and make sure we're protected in the future.
Yeah, I appreciate that. I'll tell you, one of my biggest frustrations until I really just kind of gave up on the market is seeing the almost endless number of primarily real estate people, right, who are raising funds and they don't know what they don't know and they're doing it illegally, right? And when I try to reach out to them, and they could be startup with just 7 figures under management. I can think of another example that had $1 billion plus $1 billion plus under management, and the response is always the same. Like, we know better. They conflate their real estate expertise with the holistic expertise required to operate inside the bounds of the law. And I have no interest in being legalistic. I do have an interest in being profitable and not going to jail. So yeah, that's actually the biggest frustration I faced until I just really gave up on the market. And it didn't matter, and what I mean by that, the market is predominantly the real estate space, where you've got startup, new fund managers, you've got $1 billion plus fund managers. I don't care if you just started a year ago or you've been running it for over a decade. That is not an indicator that you're doing things well. And when I approach people who have great potential, and I'm like, hey, you've got a lot of good stuff going for you, but you're breaking the law with how you're raising money right now, and it wouldn't take a huge adjustment to become compliant. And again, kind of like the finance industry, they're equally as dismissive because they think they know better, right? They don't know what they don't know, right? And securities law is not part of the 6-week real estate license course, right?
Sure.
So anyway.
And Ben, we both said earlier, it's not how much money you make, it's how much money you keep. And that's true for us as individuals. That's true for if you're an investment professional. If you've got other people's money, it's true for them too. Like, I mean, you need to be compliant.
Again, compliance is, as you pointed out, a non-negotiable. You have to be compliant. And like PMV, they were running their firm for close to a decade, if not more, right? When I was engaged with them. Another one that was, another one that was 5 to 10 times bigger had been running for over a decade. Their principals wound up in prison. Told them the same stuff, right? Didn't want to listen. And so, again, it's, I'm reminded of the term common sense that you often use, but it goes back to what I consider to be a different type of psychological defect, right? At other times, I'll talk about my journey into the domain of finance and how people are unwilling to prioritize their own evaluation over their peer pressure, right? So they just don't have the strength of personality, the strength of character to do the right thing in spite of what their peers are pushing them to do. It's a different psychological challenge on the real estate side. It's an incredible level of arrogance and ignorance, right? Yeah.
And the ignorance is the thing. And I mean, for those, I think everybody's smart enough on this call to know, but I mean, definition of ignorance, we're not saying you're stupid, but the definition is lack of knowledge, right?
Just don't know.
You just don't know. And guys, to double down on what Ben's saying, what we're talking about here, and trust me, as a real estate guy, you could have the best strategy in the world. You could execute on that strategy perfectly. Every one of your investors could make 40% returns. And if you didn't do it compliantly, you could go to prison. Yep. Even though everybody made a profit.
Yep.
Right?
To put
That's how important this is.
Yeah, to put a slightly finer point on it, what the law strictly says is that if you unwittingly break the law, you'll get a warning. If you break it again, you're going to jail. That's the theory. In practice, that's not how it works. It's kind of like the analogy of the cop following the guy for 500 miles and finding something inevitably. What will always happen is the SEC will find some fraud charge to throw on top of that. So
if they want to.
Yeah, right. And it, yeah. There seems to be more draconian penalties placed on small private operators than on the big firms for doing the same stuff, right? And so, yeah, following the letter of the law, you may get a warning. You would only get a warning the first time, but when again, a charge isn't necessarily proved, right? They can make the claim, oh, he was also committing fraud, and they can work, and probably often do work, diligently to justify that charge. So you don't want to open the doorway to that experience, because there's nothing good will ever come out of having the government over your shoulder, ever. Nothing.
White-collar criminals don't do too well in prison, I would think. So let's not make that dream a reality.
Yeah. But anyway, so yeah, just to sort of button that point up is that, again, on the real estate side, and I've just kind of walked away from it largely, it's like you can't convince people to value things that they don't already value. And when I say, hey, I know you're making a lot of money and you got a large following and everything looks good, but you are breaking the law and it's only a matter of time, they're just not receptive because they're not predisposed to being receptive.
Well, and that's why I'm passionate about what you do, Ben. I mean, it really is. I mean, you know, I'm number one, like we've talked so much about all the conversations we've had on your podcast here and personally. I care about the investor. I care about the individual empowering themselves to make informed decisions and kind of take their control of their financial future away from Wall Street, the big banks. But I really care, too, about the people like you, people like me, the people that have the guts, the balls to want to create something. And it tears me up that there's people in this country that can have that initiative and that desire, and they can be talented. But if they just don't know what they don't know, they could get in trouble. That, to me, is sick. So,
and they do get in trouble all the time.
They do, and it's horrible, right?
Yep, it is. And again, this is the theme that sort of overarches everything that I discuss. But I don't want to leave compliance alone, right? And what I mean by that is being compliant will keep you in the good graces, or at least out of the crosshairs of the government. But developing and executing a responsible strategy with what I'd call institutional grade operating standards that make you a responsible steward of other people's money, with a strategy that is objectively better than what's available through the mutual fund market. All of that goes hand in hand, right? And so, and that's this conversation here is a reflection of your perception of me, and I guess an extension of our introduction, where I'm the compliance guy. But when I transitioned out of real estate into finance, compliance was only one part of that. The real lead for me was the quantitative risk analytics, measuring the risk, measuring the quality, communicating the quality of investments in portfolios. And then by virtue of understanding the compliance, understanding how to measure and evaluate investments in portfolios, ultimately leads to how do you engineer and design investment products that are marketable, that are objectively better.
And Ben, I'm so glad that you said that, because you just really brought everything full circle. What I mean is, so we've talked in previous discussions on your podcast about the returns you've generated, right? So it's crazy. And again, for those who haven't seen some of the other stuff, I invite you to check it out. But if you haven't, this guy, if you look at the documented track record since 2007, I believe, so going on about 15 years, 20% plus every year. 2009, you outperformed the S&P 500 by 70%. So when you hear these crazy numbers, normally, my brain anyway, associates that with a level of risk, a higher level of risk, because they're extremely high returns and consistently high returns. That's why it's so credible. That's why it's so, honestly, shocking to me that a compliance that I knew, I know you're not a compliance guy, but that I knew originally as a compliance guy is also a high level, high return investment guy. Those two things don't normally go together. Normally, if someone has that high upside brain, they don't care anything about compliance. Normally, if somebody cares about compliance, they're doing 6%, 4%, 2% treasury level risk stuff. You've managed to combine, and tell me if I'm wrong or if I'm being overly excited, but you've managed to combine treasury level risk type opportunities in that range with these 20% return track records every single year for 15 years.
Yeah, and that is by virtue of bridging the gap between private markets with institutional grade infrastructure, right? So early on, relatively early on, 2007, even through 2015, 2016 is when I sunset my ABL strategy. That strategy was able to generate that performance. And then all of the liquidity sloshing around in the market started to bring down the yield on that front. We were still able to do well because of the unique structure, even within the ABL space. But now we've migrated into GP stakes allocations, which is the same stuff that Goldman and others are doing. And that's how you continue to generate exceptional high yield, low risk returns. Because now on the GP stake side, the strategy becomes largely inconsequential. We're just getting paid on the assets under management. So now basically if you raise money, we get paid. Or if we raise money, we get paid, right? So I don't mean to imply that there's one silver bullet strategy. We've, like, as a de facto boutique investment bank now, from a regulatory perspective, we're an investment advisor and fund to funds manager. But when you look at it from that perspective, we're now leveraging the performance of many different asset managers across asset classes that we cherry pick based upon performance. And then not only are we cherry picking their strategy, but then we're participating in many instances as a co-GP.
Well, so Ben, for those that aren't familiar, can we just take 2 minutes and just kind of walk through what you mean by GP stakes, what you mean by co-GP opportunities, because it was unheard of, and I feel like this is going to be like how self-directed IRAs were 12 years ago, to where nobody knew about it, then everybody knew about it.
Yeah, so I certainly did not invent the notion of a general partnership or a co-GP, right? But I would suggest that our twist on it is unique, and I think that we've brought the idea to the public in an unprecedented way. So that's probably a fair statement. GP stands for general partnership. Technically speaking, it's a legal structure. It's a partnership where all of the partners share management and liability responsibilities, as opposed to an LP or a limited partnership where the limited partners don't share that management responsibility. So now that's the sort of the quasi-technical definition. The operational definition is a little bit different. So when a fund is an entity that a bunch of different people, passive investors, put money in, and then one manager takes that money and manages it, invests it in a strategy. So that structure has traditionally been a limited partnership where the investors who put in the capital, the money, the passive investors are the limited partners. And then the manager who trades the strategy is the general partner. He's the manager in that entity. Now, a fund can be structured as a limited partnership. It can be structured as an LLC. Most often, our structures are LLCs. They're not LPs. But we still use the term GP loosely as a synonym for the manager and LP loosely to describe the passive investors. So the way a manager of a fund, the way a GP gets paid, generally speaking, is in two ways. They get paid a management fee, which means that every year they get paid a small percentage of the total amount of money or the total value of the assets in the fund. So the traditional fee structure that most people are familiar with is called the 2 and 20. 2% being the management fee. So 2% of the value of all the assets, counting all the cash and all of the illiquid assets, everything held, 2% of that value is paid to the manager as compensation every year. That's the 2 part from the 2 and 20. The 20 part is the 20% performance fee. That's the incentive allocation, which means that everyone wants interests to be aligned so that if the fund does well, if it performs well, then the manager gets to keep 20% of the gains, and the LPs, the passive investors, keep 80% of the gains. So that's the 2 and 20. 2% management fee, which is 2% of the total assets under management every year, no matter what. Then the 20% performance fee, which is 20% of the profits. Now, they're usually thresholds or hurdles, but we won't go in all the fine points. That's the general idea. So when most people invest, they're thinking in terms of investing as an LP, which means you are passive, you put money in a pot, somebody else is going to manage it for you. Go ahead.
Kind of the equivalent to if you threw your money in a mutual fund with TD Ameritrade and you get a statement, but you have no oversight whatsoever, no control, no knowledge of even what the fund is investing in.
Well, you may know what it's investing in,
but you might not.
Yeah, you may know, you may not know. So each fund has different levels of transparency, right? So like federally registered funds will be ostensibly more transparent, although in practice they're probably not. But they'll have more rigorous reporting requirements. On the flip side, like neophyte real estate funds are probably the most opaque and, I don't
know. I hate Wall Street, Ben, but if I polled 100 people, if they knew what their 401k was invested in on Wall Street, I bet you 95 of them have no clue what actual companies their funds invested in.
Understood. And I fully admit that information is not readily available, but theoretically it's accessible, right? Whereas in a private fund, you can be deliberately and transparently opaque, if that makes sense, right? This is a black box. We're going to go buy real estate with it, and we're not going to tell you what's in it. Now, a lot of real estate funds don't operate that way. A lot of real estate people actually syndicate on a deal-by-deal basis, and like, here's the brick you get to touch that we're going to buy. I mean, that's what happens in practice most times. But that doesn't account for all the abstract stuff, like how the management is run, which is like how the performance is constructed. Anyway, different conversation, I guess. So why is that important? Well, the GP, the manager, gets paid regardless of whether or not the strategy performs well. Now, he gets a bonus via the performance fee if it performs well, but the GP gets paid, remember, 2% under the 2 and 20 structure, 2% of the total value of all the assets under management every year, forever, as long as the fund exists. So what we do and what other investment banks do to get out of the business of market and strategy risk is to say, fuck it. I'm just going to buy the fee structure of the manager. And that's what we do. Granted, we still maintain the same rigorous quantitative underwriting we always have. So we only work with managers who were underwritten across 2008 and are expected to generate outstanding performance no matter what. Yeah, our investments are not only market neutral, but they're also strategy neutral now, right? The strategy just becomes a bonus. And so, in short, it does look incredible that any firm or anyone can achieve double-digit returns every year across market cycles. And I'll tell you, there is no silver bullet. I don't know of any one strategy that will consistently perform that way.
Man, I got to stop you there because I think that's the key. This is me from the outside looking in as your friend, as somebody that is an investor that's had some success. To me, you tell me if you think different. That's your key. That's why you've been so successful. It's not one strategy. It's not one investment. It's the flexibility that your infrastructure provides to be able to pivot from one strategy to another, depending on what the market dictates, that allows you to get that 20% plus. Because, I mean, my returns in 2009, me personally, were probably 200%. But then I've had years where I'm negative 200% too. You, with your strategy, have been plus 20% every year for 15 years, whether the market's good, bad, indifferent, always plus 20%. I think that's because you've got the flexibility to pivot between different asset classes, between different strategies, to find what works at that particular moment. Tell me if I'm wrong.
I would just add to that a little bit, right? So it's not even a soothsayer's perspective of just recognizing what's good. It's taking the esoteric skills of the big wirehouses, the shadow banks, and employing them for my own benefit. It's not a strategy. It's not a guess. It's the shadow banker's secrets.